inspiring entrepreneurs to rise, innovate, and create lasting impact. And today I have my special guest. He is the founder of the Score Machine, of the credit funding strategies who help entrepreneurs optimize their credit profiles. None other than Mr. Ali Badi.
Hey, how are you doing? How's everything, Daniel? Appreciate having
Well,
me on the show.
I'm fabulous, Mr. Ali, and welcome on Entrepreneurship 101. And can you please introduce more about yourself that I mess?
I'd love to. My name is Ali Badi. I'm the owner and co-founder of the Score Machine. I'm the head designer of all the AIs inside of the software. Um, been doing this for 4 years, designing the ability to take people to the next level inside of their uh, business by utilizing AI to analyze your credit report, view if you're institutionally ready, and then match you with the institutions that are ready to give you funding. We are a US based software that really takes your small business and business to that next level by matching you up with the current banks and the proper banks.
Wow, we like that, Mr. Ali, to the next level indeed. And thank you so much for sharing your knowledge and wisdom to the world. So today let's talk about the credit score don't get you approved. Institutional readiness does. So tell us, we thought building a credit is a path to approval. Why do you
Mhm.
think the narrative has stayed so focused on the individual score rather than institutional capacity to lend?
So what happens is when they focus on the individual, when you focus on the score can be artificially increased. We know the people that are in the service industry and in the credit industry know that you can raise your score artificially by doing certain things. And I'll give you an example. I could get an authorized user on my account. By putting an authorized user on my account, I can jump my pointage up immediately by doing that. So if I understand that the institution understands that, then the institution is going to put parameters in not to just give everybody money. So what you have to do is understand what the institution is looking for. If the institution is looking for just give you an idea, if the institution is looking for you to have $1,000 in the bank and you have 500, that's not something that's going to get you institutionally ready. So we know the metrics for the institutions and we put them in the software. So you pull your credit report in, okay, you pull it from a third party, you run it inside of the software, and then it matches you up to the what the institutions are looking for. So just to give you an idea, people don't get there's 7 reasons why people don't get approved. There's the 7 reasons why I put it inside the software. And I literally put it inside the software to make life easier for everybody. Some people don't have time. It takes about 3 to 4 minutes for the AIs to get rocking and rolling. But in 3 to 4 minutes, you know exactly what you need to do. You literally can go and be like, oh, I'm not ready. I'm not going to waste headway. I'm not going to spend time not doing this. And I'll give you 3 examples of how people are not ready. Here, you're overutilized. You spent too much money. You don't have a credit score that's proper. You don't have the requirement of banking relationships that are needed. Okay? So that's 3. I'll throw in an extra one. You don't have a positive account. What does that mean? You may have collections, you may have charge offs, you may have late payments. And in that sentiment, if you have any of those, it'll throw the bank off your scent because they don't want to deal with somebody that has that. Does that make sense, Daniel?
Makes sense, Mr. Ali. Let's defining the term. If we remove the credit score from the center of the universe, what does institutional readiness actually look like in the bank balance sheet?
So, institutional readiness, if you remove the credit score, it means it's a perfect profile. It's what we call the Cinderella profile. It has every product that the bank is looking for. It's got the proper amount on it. It has the excuse me, it has the proper amounts. It has the right utilization. It has the right banking products. It has the no negatives, things that we just spoke about, um, and a couple of other items that are in there that we do in our forensic analysis that would be in there, and that's what the bank is actually looking for. We want to get people to say, stop looking at the score, look at the profile. If you look at the profile, the score will come. If your profile meets their parameters, you become fundable to them because the score matches. That's the key. It's like build a building, right? Put no apartments inside. Is anybody going to live in the building? No, right? But if you build apartments,
Certainly.
you build amenities, you build things like that. Are people going to want to live in the building? Yeah, boom, they're going to come flock into the building.
Very well said, Mr. Ali. So, the macro view, when we look at economic cycles, it often seems like a credit tightens or loosens across the board, regardless of individual credit worthiness. How much is getting a loan is timing the bank's mood versus perfecting your own file.
Oh my God, that's a really good question. Um, that's all. It's very good to understand what they're looking for and when they have money to give. Let's understand the banks are never losing money. If we understand that key that the bank is never losing money, it's always a good time to get a loan. Their money is made on loaning money. So credit card is a product. Remember, product is a product for them to loan you money to make more money. Because what happens is they split their money debt around. So the more that they have split around, and the more stuff that they have split around, right, loans all this stuff out, and they give the ability to go get that money. Now, the limit is what affects during a downward time. So, for example, we're in a good economic boom, everything's amazing, right? Pre-COVID, right? A personal credit card you can get with $50,000 on it, right? Personal, not business, personal. Probably can get a business credit card with $150,000 on it. Now we're seeing $50,000 on the business, 25,000 personal, almost cut in half. Does that mean that they're not giving money out? No, they're giving money out, but they're giving people who are institutionally ready money, not the people who are, maybe I'm a little ready. Make sense? You're also going to see too, Daniel, I wanted to say, you're also going to see too that the banks are reducing limits now for people that have high limits, that their risk assessment is going higher because they're not staying in the institutional ready box. They're now going outside of the box, which is now causing them to have high risk. And the banks don't like risk. So now they reduce your risk assessment.
Well, very well said, Mr. Ali. And does the credit score give consumers a false sense of control over the approval process when they really are just a passenger on much a larger institutional ship?
Yes. It gives them a false sense of hope. Like I said, we can artificially raise a credit score to 850, but it does not mean that is a fundable score. It means that your score is 850. It means that, yeah, maybe some schmuck company will give you ability to get some credit, but it won't be the overall banks or the major banks in the United States that'll give you that money. So what we need to do is understand how to become institutionally ready, be ready, and not focus on the credit score because let's be real, the credit score comes when the file is built correctly.
Be ready, people, be ready. So let's talk about the liquidity versus credit score. Walk, walk me through the scenario where a borrower has a great score but gets denied purely because of the lender's liquidity ratio is out of whack. What happens to behind the scenes?
So what happens is when the bank has got liquidity is too high, what we're looking at is bank is over leveraged. That means they're levering they're lending out too much money. Hence where we were talking about the um them lowering their limits down. That's the liquidity's out of whack because the, the economy is not doing so well. Let's be real. When there's more money flowing through the system, right? The liquidity of everything goes up. When there's less money flowing through the system, then liquidity goes down. They have less money to give out. So what we tend to do is look for banks that are not as mainstream. We have 2,209 banks inside the software. Over now, I think it's over 7,000 products. And with over these 7,000 products that you can look at, you're gonna find a bank that has the liquidity to give you. So it doesn't matter. It's just where it is and what we are looking for at that point in time. The AI is always searching to make sure that everything is good.
So, Mr. Ali, how much does institutional ability or inability to sell loans on the secondary market dictate who they approve on Main Street?
So letting them sell the secondary loans, you were talking about mortgages and high level loans. For example, you're talking about $1 billion loans. They'll move these loans around from bank to bank to bank to bank. A loan that's given out to an institution, for example, such as myself, a small business, you're looking at this loan being with you forever because they want to collect on the loan. The loans that are being sold, they know that the collection process is going to be a lot harder, so they're usually selling those off, and that's the key. And that having that loan not being sold off means that they're losing the ability to move that liquidity off of their board and now have the money come back in. So it hurts the small person when they can't move the big loans, but those are smaller banks. The bigger banks have $1 trillion of liquidity, and they don't lend as easily that big money. They want to lend to lower institutions. Um, as best as they can because they know there's a better chance of them getting more money. And when I'm talking about lower institutions, I'm not talking about the solopreneur or the starting entrepreneur. I'm talking about that mid-level entrepreneur that's making that $1 to $10 million, $1 to $15 million. I'm talking about that guy. They want to lend to that guy because he's proven that not only has he made the money, but that he's capable of making the money over a certain period of time. And that's the person that they want to lend to. They don't want to lend to somebody that is not capable of making a repayment. That's the key. So those lower people, they're not so much. The higher people, not so much. There is a sweet spot that they're looking for because they want to make sure that that money is coming back in.
Mr. Ali, let's talk about the risk appetite. Every institution has a risk appetite statement. What are the top three variable inside that statement can override a borrower's excellent credit history?
So it doesn't matter about the excellent credit history, which we spoke about that before. The institutions don't look at the credit history; they look at the overall totality of the file. That their risk appetite is very high if your totality of your file is amazing, but your risk appetite is low, even if you have a perfect file in the sense of a perfect score. So again, we need to make sure that they understand that it's not about the perfect score; it's about the perfect file, and the perfect file is the key. That risk appetite goes through the roof for your file because they know that. I'm going to give you a perfect example. If a person is making $1 million a year, right? They're making $1 million a year. They have a 762 credit score. They have 14 credit cards, all paid on time. They have no collections. They have no inquiries. They have no nothing. Versus a guy that's got an 800 credit score. He's got 4 credit cards, and he's got one late payment. They know with the one late payment, right, across 4 credit cards, this guy could barely manage to score with four credit cards, right? That's not what their risk assessment with him is. Not, he can't manage. Versus a guy that's got 14 credit cards, right? leverage through the roof, but he's got the ability to do what needs to be done. So it is, again, about the strength of the file.
The file indeed. Lenders often need to balance the portfolios. Too many commercial loans, not enough consumer. How does this need for balance trickle down the loan officer who is looking at my application?
So when you're looking at the application, a majority of our people that are coming in are business people. So when they're looking at the application, they're on one of those things that they don't give enough money out to the businesses. So when they're on that side, they're giving them the person that they're looking for. Now, here's the cool part: our software does personal and business. So if your software does personal and business, and you have everything that you need in front of you, if you don't get approved on one side, you can switch the gear and move to the other side. So it doesn't matter what the guy who's looking at your profile needs. It's what you need to get approved for. And a lot of the stuff that we do is online, so it's more like a digital approval more than anything.
Total digital proof indeed. With the changing base 3 or the other regulatory capital requirements, how does the amount of cash on a bank is required to hold a physical change the willingness to hand it out for tomorrow and for borrowers as well?
So cash on bank is always good. It shows your risk assessment. The more money that you have in the account, the better off you are. The more money that you have in your account, the better off you are, because it shows that, like everybody says, credit is the queen and cash is king. Cash will always be king. You need something to pay the credit with. You need something to pay the loan back with. If you don't have money in your account, how are you supposed to pay that back? Like, you guys, you gotta understand. I don't go take a loan and have no money. I don't
Mhm.
go get a credit card and have no money. Yes, you have it in hard times, but here's the goal. Here's the goal is to make sure we get it immediately and understand that money's got to be flowing to go get the cash.
So, Mr. Ali, beyond the score, are we seeing the shift where lenders rely more on cash flows analysis than the traditional FICO score, or especially in the SMB space?
Yes and no. Cash flows for bigger loans, smaller loans, smaller credit cards, things like that. They don't care about cash flow. But cash flow comes for bigger loans. You're doing 250,000. You want 400,000. You want a half a million. You want $1 million. They're gonna need to see cash flow. But the bank also, not to say that this is not true, the bank also looks to see what you have in your account. If your account has 50, 60, $100,000 in the account, then they know that you're a viable business. But if you don't have 50, 60, 100,000 in the account, right? And you're asking for a 200, 300, 400, 500, $1 million line, they're not going to approve you because you don't have that cash flow. So yes, to a certain extent, that does matter. But to where you are in your business is what dictates if cash flow matters. If you're just getting started and you need a $5,000 credit card to help pay with the phone bill and this, that, and the other thing, no, it's not going to matter. But if you're going for, I want to purchase a brand new addition to my office, yeah, they're going to need to see cash flow.
Very well said, Mr. Ali. With the rise of open banking and APIs, lenders can now see real-time cash flow. How these institutional readiness to process the data change the approval with odds for a borrower who looks thin on paper but in cash rich.
Well, so our institutions were not pushing for those specific products that you're talking about. I'm not pushing for them for the $1 million, $2 million loans that are getting verified by Plaid and things like that, because there's a level of personalization that needs to come with it. And what do I mean is you need to have a relationship with a banker, okay, when you do this. They need to look at that. They'll be able to tell you immediately if your file is too thin, um, before you go anywhere else. So when we're looking at this, we're looking at solely based on on a credit score, and not where what the software is being able to pull your bank statements through, because that's also a compliance standpoint, and we're 100% compliant software. So because we're compliant, we went through all the compliance things with the attorneys and everything. There's certain things you have to keep out. And I would say that right now, doing a plat integration and pulling somebody's bank statements and then viewing and giving the assessment, I'm not an accountant. I'm not any of that stuff. So I want to make sure that if I were to do that, that I had a person in place that can really give me the best assessment and really put it forth, because our point is to get the people from stop getting denied. So if we don't have somebody that actually has that knowledge, we're not going to do any good.
Well, very well said, Mr. Ali. As the institutions becomes ready through AI-driven underwriting, are we solving for human bias or are we just automating institutional rigidly at the scale?
Conservatism. Conservatism when it comes to how you underwrite the file. Look, I'm an underwriter. The software is basically an underwriter. So what happens is, if the underwriter is looking for $1, I say have two. If the software is looking for, just giving you an idea, if the software, if the underwriter is looking for, um, if the underwriter is looking for 20% utilization, I'm telling you, you need 10. If the underwriter is looking for, um, no late payments, or one late payment, I'm telling you, no late payments. So I don't care what they're suggesting. And I'll be honest with you, I don't care what they're suggesting. What I am doing is making sure that your file does always, when it goes over there, has the best chance, the absolute best chance of an approval. Not, no guarantees, again, because that's not compliant. All right. That has the best chance of approval. Because if they say one thing, I'm doing less. Conservatism.
So, Mr. Ali, let's talk about the red flags. What are the tells that institution is tightening its belt and becoming less ready to lend, regardless how good the application looks like?
So the only red flags our clients will see, ready? The only red flags our clients will see, ready for this,
Yes.
is that they did not blacklist themselves on that bank. That's the only red flags. Because if you are truly institutionally ready, on a conservative standpoint, there's no reason that they shouldn't lend to you, even $1, even $1. It does not matter. They will give you something. Not guaranteeing anything, again, like I said, for compliance. But truth be told, if your system and you're running it through the system and you're looking at it and the conservativeness that we have and all that stuff, your file is going in and you have the best chance of making sure that you get something with us than you do with other brands. Well, I don't think there is any other brands.
Best chance. We like that. The best chance, Mr. Ali. For the average person, does the existing banking relationship, deposits, or payroll actually force an institution to become ready for them by passing the score?
Hmm. Can you repeat that one more time? I just want to make sure that I understood what you said.
Yes, definitely. The power of the deposit, what we are talking about. For the average person, thus the existing banking relationship, like deposits or payroll, actually force an institution to become ready for them by passing the score itself.
So the deposit will help you because it shows that you have money flowing through your system. The more deposits that you have, the more money that you have in your bank account will cause you have a banking relationship. That's what that is. People know you at the bank. They want to do business with you. Versus somebody that they don't know, somebody that is just, on paper. E-commerce businesses probably never stepped foot in their banks. Okay, think about that. While a plumber is probably in his bank every single day, doing a cash discount, not cash discount, cash deposit or whatever into the bank accounts or whatever, pulling money out, going to buy whatever. So they're going to be more inept to give money to the plumber than they are to the guy who's doing business e-commerce wise because of the cash deposits that they could see and deposits in general, just seeing the deposits. And I'm not going to say that the e-commerce guy doesn't have a good chance. I'm just saying that there's a difference when the bank manager sees you and knows you versus a guy that they have no clue that never leaves his house. Make sense?
Makes sense, Mr. Ali. So, with the potential recession talks, are we entering period where credit scores matter less because institutions are scrambling to they hoard cash or deplete it very defensively?
Again, with us, the way that we look at it is it doesn't matter what you're going to do. They're always going to lend money. That's how the banks make money. They have to lend money because they
Mm,
charge you a nominal fee, right? Think about this. They charge you a nominal fee to keep a bank account. Okay. They're not going to be $1 trillion business if they charge you a nominal fee. So what do? They have to do? They have to lend money. They have to lend money via mortgages. They have to lend money via credit cards, et cetera, et cetera, et cetera. So what happens is they are going to only look for a file that is truly good. They are not going to look for a file of somebody that is like they used to. So
mm,
come the recession, if you got an file, yeah, you're not getting money. But if you come to a recession and your file's decent, you're showing that you're making money, you're showing that you're doing X, Y, and Z. Look, a recession now is very different than the recession back into the 1920s. Recession is completely different where business just hard there's harder money. Money is harder to achieve outside, but money's still out there. You just got to know who to look for and where to look for it from. And that's the key. And that's when you know that you can bring money from this group over here. You're always going to bring money from this group. So what's really the key? Inflation, all that stuff only affects a certain class. It doesn't affect the class that has money. That's the key. So we need to focus on getting ourselves to that point.
very well said, Mr. Ali. If governments move toward digital currencies, will the concept of private credit score becomes obsolete, replaced by a government-controlled view of institutional readiness at the federal level?
No, because in the United States, no. I know in China they do have a socialization score, so we have to look at all over the world and see what's going on. But in the United States, it's never going to be replaced by one institution because one institution cannot govern itself objectively the whole time. So that's why there's three institutions currently looking at the credit score and giving you a risk assessment. That's why when you're looking for the most money from the bank, they pull all three institutions. So my suggestion, and again, this is my opinion. I'm going to say my opinion, no. But I don't have the power, or I am not of a power at B that controls that. I would hope one day to become one and always fight on the side of that. There should never be a government institution that's running my credit score. I do like having it private because there's a level of law that they have to follow versus a government. The government doesn't have to follow the law technically. They can do whatever they want because they're the government. Who's going to stop them? But if it's a private institution, the private institution has to watch out for the government.
Ali, before we wrap up our discussion for today, I'm inviting you to please do listen to my other podcast, people, because my Abstract Casa is already in sixth season, Abstract Poetry in third season, and my Book 101 review in sixth season too, Comedy 101 fourth season, and my Food 101 in sixth season as well, Geography 101 Love Letters, Movie 101 review, Music 101, our fifth season, Science 101, Sex 101, and it's fourth season, Trivia 101, Motivation 101, Spiritual Awakening 101, Mental Health 101, Entrepreneurship 101, Coaching 101, of course, Bible Verses 101 on my baby podcast. Please listen to them wherever you listen your podcast. So, Mr. Ali, fintech often market themselves as looking beyond the credit score. Are they actually better at regarding institutional readiness, or are they just a rigid but with the better marketing?
I mean, I'm a fintech, so I would say that we're better at doing everything because we're viewing everything differently. We're not viewing, as I said before, we're not viewing the profile the same way as other people are viewing the profile. We're viewing the profile for exactly what it is. So the key of that is to make sure that the fintech does what it needs to, and that the fintech will always view and use technology to better do the betterment for the person that's behind it. So for example, we want to make sure that we're always doing right by you, and the software should be built for you.
Mm. So, Mr. Ali, can you expound more the phrase on your website, next generation credit intelligence for professionals?
We're not utilizing the old generation's way of viewing the file. We're using AI, we're using all this new technology to build up so that you can view your profile or your client's profile within minutes and know what the bank is thinking of and know what the bank is doing. We want to make sure that your file is ready to go to the institutions. That's why we're next generation.
Next generation indeed. So, Mr. Ali, can you please invite our listeners to support your advocacy, your business, or whatever projects that you're doing right now?
They're more than welcome to join us on the Score Machine. Go to thescoremachine.com. And then also, you can find me at Never Enough Time 89 on Instagram. And all my stuff is basically on Instagram. Got my link tree, all that stuff over there. We do have a YouTube channel. We have a bunch of stuff that we do. And I do whole courses like this and questions, Q&As, things like this once a week on our YouTube channel. All right?
Yes. Will you be my guest, our regular guest on Entrepreneurship 101? And please enlighten us more about this breakthrough.
No problem.
Thank you so much. So, I have one more question. The $1 billion question. If you could design a borrower readiness score that actually measured how ready a borrower is to be approved based on the current lending environment, what would be the number one data point you include that the credit bureaus ignore?
The number one thing that the credit bureaus ignore that an instant money in the bank. Money in the bank. Because the credit bureau doesn't have access to the bank, your bank account. They only have access to your credit profile. So if you're really looking at it, having that extra money in the bank, having that little extra, keeping that $5, $10, $15, $20,000 in the bank, right, in your business bank account, and telling them that you're looking for that money, that's the key.
Very well said, Mr. Ali. So thank you so much for your time.
You have a great day.
Monica people, see you soon.